I want to say thank you to Estate Living once again, and of course to 10X. I think it's a fantastic initiative to get people out of their homes and to get people talking about money. I think it is really, really important. Guys, if you do have any questions, at the end of this we will be having a quick break and then there will be a panel discussion. If you have any questions, please don't be shy, engage us, ask the questions, put us on the spot. We have got thick skins and we'd love to take your questions. So the most common question I get asked by people, and this is across age groups, where should I invest? Where should I put my money? Times are uncertain, where should I be putting my money? And in my personal view, not only is this the wrong question to ask, but it also highlights the problem faced by so many investors. Investors don't necessarily, as individual investors, know exactly what instruments are available to them. They're very reliant on brokers. And in my opinion, based on my experience, this is probably the last question you should be asking. And I'll explain in detail why I say this today. And I'll also be highlighting some of the questions you should be asking when you're looking at your retirement, when you're looking at your investment funds. But before we go down that road, I want to give you guys a little bit of personal background, and I won't go too deeply into it, but I think it's really important to understand who I am, because it's one thing to hear me on the radio and to see me on television, and it's a personality, but who you get your information from is as important as the information itself. And I think that is the critical aspect about transferring knowledge and information. So in the world of money and finance, I'm completely unique. I'm a complete maverick. What I do and how I look at money has been shaped by a collection of life experiences that I'm sure many of you will relate to. I don't comply, I question everything, and when it comes to money, I don't trust anyone, especially not family. And part of this reason is I grew up extremely poor. And it is hardwired into my instinct to survive, to question everything. This is how I survived. I also happen to have an unnatural obsession with numbers and compounding. And this, of course, makes for a great investor. I find solitude where some people do crossword puzzles, I do complex algorithms and mathematical equations. This gives me peace. A lot of fun. And of course, I've been homeless for a large part of my life. I was homeless. There's a big story behind it. If you guys would like to know that story, please come up to me afterwards. But being homeless taught me something really important. It taught me that money is a very important resource. It taught me to separate emotionally from money. It taught me to look at money the way you look at water or electricity. It is a resource that needs to be managed, cared for, and looked after. Because money is the only thing that separates us from sitting in a lovely estate like this, having lovely coffees, and listening to a wonderful speaker, or being out on the street. And that is the reality. And sometimes we lose sight of that. Sometimes we think it's a new car, it's a new dress, we think about all these things that it provides. But what it really is security and, most importantly, dignity. Money provides dignity. So in terms of my business background, again, a very unique story. I started my first business at the age of 13, purely out of necessity, not because I was a genius. I went to school just down the road here in Pietermaritzburg at Maritzburg College. I don't know if there's any college old boys in the room. Fantastic school. They took me in, and I had to figure out how to pay for school uniforms because I was on a bursary. And so I started cutting hair at the age of 13. That progressed to buying the school tuck shop, and from there the Entrepreneurial was born. Since then, I've created over 100 companies, many of which most of you have probably interacted with at some point in this country. But I've been very comfortable being in the background, For obvious reasons, I like to say in this country I'm a pale male, and you don't want to wind your neck out too far in this country. So I've had a strange experience for the last couple of years. I've been putting people in the front and I've been in the back. And COVID hit, and I decided people were suffering. I could see people were really making bad decisions financially, and I wanted to help people. And I started talking. And slowly there was a groundswell that built, and radio got hold of me, TV got hold of me, and this is how I landed up here today. The interesting part about my journey in creating these businesses, a lot of these businesses are actually in the financial space, and considering I don't come from money, I didn't go to traditional financial schools, I come from outside the financial establishment. So I look at money very differently, and I question things from a completely different angle. All of the businesses I built with no funding. I've never taken on a single rand or dollar in investment. I've bootstrapped every single business I've built. And the reason I'm telling you this is not for my own ego, but to explain my investment thesis. If I risk everything I have on building businesses to create money, I would look at my investments exactly the same way, with the same level of scrutiny. They have to produce a return. And I scrutinize every investment accordingly. This, of course, is a big part of my investment strategy. So my investment background goes back about 20 years. I started making money on the advice of an older generation: buy property, have a retirement fund, the basics. And this just didn't add up to me completely, because I started to look at pension funds, retirement funds. I started to look at the problems that could be coming. And I decided I needed to start figuring out how money works and the investment strategies that work for extremely wealthy people. And so I started to move into the stock market. But not stock trading, stock investing. I've held the same 20 companies in my portfolio for 20 years. I also bought into real estate, property. Big believer in property. I think property is always going to be a great investment. I then started to self-invest into bonds, into the bond markets. I started to figure out how that worked. And later, I gravitated across to private equity. I started to put money into my own private equity funds. Today, I'm proud to say, I will invest in anything that makes money. Anything that makes money, I'll put money into it. And there are a lot of investments outside the traditional landscape, which I think this next generation coming through is so lucky, because they've got access to things that your generation and my generation is just on the cusp of being there but maybe missing it. There's investments coming out that allows them to be part of things that we probably wouldn't be able to be a part of. There's great opportunities out there. But I have 3 simple rules for investing, no matter what the asset class, no matter what the investment is. And I've held this true, and it goes back to what I was telling you guys about why I got into business, how I started business, and the importance of making sure businesses make money. My 3 investment principles. Number 1, it must preserve capital. And I'm sure every single one of you can appreciate that rule in this room. Capital preservation is super important. Second thing, it has to make sure that there is cash flow. It has to cash flow. Third thing, it must appreciate in value over time. This is one of the reasons I personally love real estate, specifically rental real estate, because it ticks all 3 of those boxes. And real estate continues to be a very strong portion of my portfolio. So of course, we're all uncertain about South Africa. 8 years ago, I started to see some dramatic shifts around the border and table. I've been privy to a lot of conversations high up at government level around very prominent businesses in the country. And I started to notice a strong sentiment shift. I started to look at my own businesses, and I started to get worried about the political and economic future of this country. And so I decided to offshore 8 years ago. I offshored initially my businesses, and then I started to offshore myself. I started by moving my tax structures, I started by moving my asset structures, I started by moving investments into overseas markets. And what I can tell you is I've spent the last 10 years solid looking for a plan B. And let's be honest, we're all talking about plan B in case the brown stuff really hits the fan here. And that looking for plan B has taken me to 77 countries. I've got on a plane and gone and lived, integrated, collected my mail, opened a business, seen a lawyer, consulted with a tax consultant. I didn't just go sit in a 5-star resort and drink mojitos. I literally went and engaged on the ground. And what I can tell you is the grass is not green on the other side. Same problems but different. Same problems but different. There is no perfect other place. There's no perfect government, there's no perfect country, there's no perfect currency, there's no perfect system. So for me, it's become about diversification. It's about diversification of structures, diversification of how you set yourself up, globally, locally, from a tax perspective. It's all about being diversified. And so the way I approach my life and my investment strategies and everything I do comes back to one simple question. I go where I'm treated best. Where am I treated best? Where am I treated best for banking? Where am I treated best for tax? Where am I treated best for living? And the great thing about this global world that we live in, and a lot of people don't know that this is available, but you can live here and you can bank in another country. You can live here and reduce your taxation by putting tax structures elsewhere. But it is a difficult and a long road, and I've invested 8 years into this process and a lot of money to get to understanding this process, because lawyers don't speak to tax consultants don't speak to immigration consultants, and there's a disconnect. But what I can tell you is I now in my life adhere to what I call the flag theory. I plant a flag in a jurisdiction where I get the best treatment for something specific. So if I get the best treatment for banking in Mauritius, I bank in Mauritius. If the tax structures for my setup work best in the Seychelles, I do that in the Seychelles. If the cost of living is best in South Africa, I try to do most of my living in South Africa. If holding assets is best in, say, Australia, then I hold assets in Australia. It's all about going where I'm treated best. So, unfortunately, we have to talk about some bad news. Show of hands quickly, how many people watched the budget speech yesterday? Or even got a glimpse of it? Highlights. Okay, by show of hands, how many people thought it was positive? Okay, how many people thought it was negative? How many people just thought, man? Okay, so we all pretty much share the same sentiment, right? I tend not to offer too much commentary on anything that's sentiment-based. And the reason for this is I don't read the news, I don't listen to anything media-related, which is quite funny because I spend a lot of time being in the media. Because I follow numbers, economic data. People can say things, but the data tells the truth. I'm very data-driven. And as South Africa stands at the moment, and I don't want to scare you all, but we need to talk about some reality. South Africa is a mess. The tail is wagging the dog in this country. We have Labour dictating to business. We have a strong communist socialist agenda pushing up against capitalism. And these forces are at odds with each other. How's it going to play out? I don't know. We all think we know, but in reality, we don't. Domestic politics doesn't exist. It's a joke. What I'm about to say is highly controversial and may not appeal to a lot of people, but it is a fact. For as long as we have resources under our feet in this country, Western interests will continue to dictate our policies. both economically, politically, and in every other sphere. It doesn't matter which political party gets voted in, they will be controlled by Western interests. That's the bottom line. The macroeconomic picture for South Africa is not looking good. This is not based on sentiment. If you look at the graphing, if you look at the economics, you'll see that in most industry sectors we're moving to becoming a net importer of everything as opposed to actually producing, and that is a big problem for our economy. And of course, you guys will know the rand is depreciating every single year. If you fly overseas and go to visit family overseas, every year it's just becoming a little bit less attainable. But, to be fair, the world is a mess. The entire world is a mess. We've got geopolitical conflicts between East and West. Russia hates America, America hates China, and everybody is just having a go at each other. Somehow, we managed to put ourselves right in the middle of this, and we now have, of course, down in Richards Bay, we've got fighter jets and the whole military display, and of course, America is very upset with us at the moment. But there is political tension, and it's all based on countries not being able to reach equitable trade agreements. Don't kid yourselves, it's about nothing else. People will say it's about a liberal agenda, it's about a conservative agenda, it's about money. Follow the money, you'll find the story. We of course had a challenge now with the dollar. The dollar is under threat as a reserve currency, and I think it's fantastic. I think the dollar being abolished as the world's reserve currency is probably one of the greatest upsets of our times economically, but it's something that has to happen. The dollar is no longer pinned against gold. It is completely inflated by the amount of money in circulation. Most first world countries are in so much debt, it is impossible for them to ever get out of it, and it's all pegged against the US dollar. And so I believe that something like BRICS is a very, very good thing. But it's sentiment. We have to look at the numbers long term. We have to see how it plays out. But I do believe the US dollar as a reserve currency faces its biggest threat it's ever seen in recorded history. And of course, one of the big challenges, not just in the US, but everywhere, is we've got record high money printing. They're printing money like it's monopoly these days. And that's why the stuff is worth less and less. Inflation is a direct result of us printing money. And this is why we have increasing wealth gaps everywhere around the world. So it's not just South Africa that's a mess. Homelessness in America is at an all-time high. Same thing in the UK. You can't walk down the streets of London anymore. Streets of London, every little nook and cranny has homeless people in it. The world is a mess. And this leads me to the way people make decisions about investing. And of course, obviously you guys have made a lot of good choices in your life because you seem to be pretty comfortable. And, you know, I think it's a privilege that you have to try and maintain in these difficult times because we are facing real challenges in terms of the economy. But people generally lean into sentiment, and this is what I want to get across to people. This is why I'm having these discussions and trying to get out and talk to people and bring them out of their homes. Is to understand we have to disconnect from sentiment when making investment decisions. Because sentiment is all based on our input. What we read, what we hear, who we talk to, factors into how we make our decisions, where we put our money into. And the media often has a disconnect with that reality because bad news sells. Bad news sells headlines. So, the great example I want to give of this disconnect, in America right now, the wealth gap is growing faster than the wealth gap is growing in South Africa. But the first world countries are technically bankrupt, guys. We all know this. It ain't all roses. And so, in my humble opinion, investing based on sentiment is not only dangerous, it is irresponsible as an investor. The thing is, for South Africans, especially amongst your generation, the big question is security. You're worried about security, you're worried about your future, you're worried about your money. Where's it going to be 10 years from now? Everybody's worried, is this going to be Zimbabwe? Is this the next Rhodesia happening all over again? I don't have the answer. And anybody who says they do is flat out lying. But this is primarily why people look towards first world countries. People look towards first world countries because there's an illusion of safety. If I put my money into the US, or if I put my money into the UK or into the Euro, there's an illusion of safety. But if you study the underlying economic data, it is exactly that. It is an illusion. Those countries are technically bankrupt. And one could argue morally too. I do, however, believe, and this may be not appropriate for this audience, but I also do believe that the times we're living in, so this is definitely maybe something you pass down to your kids and your grandkids. These times that we're living in, as shifty as they are and as uncertain as they are times of great opportunity. And for those who see the opportunity and understand the opportunity and are the right side of the change, will make an enormous amount of money. So I personally don't like first world markets. Obviously, I think that I've made that pretty clear. And it's not based on sentiment. I find that real estate is good in first world markets. I find that stocks are generally good in first world markets. But I find in general, competition is very high in the first world markets. I'm talking about markets like Europe, Australia, the US, of course, Canadian markets, your typical first world countries. Taxation is generally higher in those countries. So the first world experience comes at a cost. And banking is horrible in first world countries. Truly horrible. I don't know if have any of you got bank accounts overseas in any of the first world countries. Interest rates are, I don't know how to say this, shite. Terrible. The worst interest rates you can ever see. And so there is a lot of advantages banking outside of first world countries. I personally don't bank in a first world country. Developing economies, on the other hand, present real challenges. We know this, we live in one. They come with additional risk, but they come with a lot of upside potential. And the way to manage that upside potential and risk is, of course, through diversification. Diversification is everything. Of course, as an institutional investor, and I'm speaking as an institutional investor, not from an individual perspective, there's a lot of tax benefits. Returns are generally higher, and there's a lot less red tape when you're investing into developing economies. So earlier I said to you guys, where to invest is the wrong question to ask. So what should you be asking when you're investing? What questions should you be asking yourself? What questions should you be asking other people when you're investing? First of all, what should I invest in? What should I invest in? Which asset classes? What asset classes do you understand? Is it property? Is it stocks? Is it bonds? Is it gold? What do you understand? What do you know? What is working at the moment? Understand the asset classes. How many people do I meet? I say to them, what are you invested in? I don't know. My broker knows. And then the broker ups and's gone and suddenly money's lost and people wonder what happened. You have to know what it is you're invested into. Very important is what is your investment objectives, and these should be reviewed all the time because your investment objectives changes as your period of life changes. Are you more into preservation? Are you more into growth? And this will be dependent on your stage of life, it depends on how much money you have, it depends on how long you intend to live. There's a lot of variables, but you need to know you're leaning more towards capital preservation, or you're leaning more towards growth. And when you know what it is that you're leaning towards, it leads you closer to those investment objectives. My three questions: does it cash flow? Is the asset going to appreciate over time? And is it going to preserve my capital? I work really hard for my capital. I definitely don't want to risk it. Otherwise, I'd go to the casino and have a lot more fun. And very important, and I think a lot of you guys could probably relate to this as your life stages have changed. Are the assets relatively easily transferable? Because certain investments you go into, especially the ones you get locked into long term, as your life circumstances change and you can't transfer out of these investments, it becomes incredibly difficult. You're locked in. And so transferability of asset classes for me is super important. I want flexibility. What kind of tax benefits are there to owning the investment? What are the tax benefits? Tax is a major contributor to the cost of your overall investments. So if you can derive benefits out of certain investment schemes that are going to give you a tax benefit, take it. And then, probably the most important question is, what are the fees? How many people have I met when I ask them, what do your brokers charge? What does the investment scheme charge? What are your fees? I have no idea. I have no idea. So let me give you guys a calculation just to illustrate this, and I did tell you guys I was a bit crazy about compounding. A 0.75% increase on your fees equates to a 30% smaller nest egg in just 20 years. 0.75% means you'll have 30% less money in your nest egg at the end of 20 years. Just 0.75%. And the problem is, it's like those debit orders on your account. You just don't see it because it compounds. So always concentrate on fees. I hate paying fees and I hate paying tax. So I try to avoid those two wherever I can. The next question I get a lot is, and you guys are probably asking this question, so by show of hands, how many people have got this question in mind? Should you be sending all of your money or a lot of your money offshore? Anybody wanting to know that at the moment? Okay. This is a common question. It's a very common question, and it's a fair question, considering the sentiment of the time. 77 countries later, having run businesses in the US, the UK, across Europe, my honest answer is no. My honest answer is no. The illusion of safety in those markets is completely an illusion. There's a better way to get diversification, there's a better way to get security and safety. But you must hedge against the devaluing of this economy and the devaluing of the rand, because it is devaluing and you have to hedge against it. And that is actually what you're after. If everybody earned dollars or pounds and lived here, they'd be as happy as ever. And that's the ultimate goal, is to live where it's cheap and earn where it's expensive. That's been my life's mission. But I need to warn everyone, when you're hedging, you can't just hedge against the rand. You have to hedge against all currencies. Because all currencies are crap. Because governments just print this stuff. It's absolute rubbish. It's paper. It's a human construct. Money is a human construct. It has no value. And so I personally hold the view that historically, looking back at the data, physical assets and commodities are always going to do very well in a portfolio. Things that you can touch, see, feel. Those are the things that are going to do well. And I don't care that we're in the internet age and the fourth industrial revolution. That's why I don't do PowerPoint presentations. I mean, I'm a total maverick for my age. Everybody's into this whole digital age, and it's great, it's wonderful, it helps us. But there's certain things that don't change. People want to interact with people, and we like to own things we can touch, see, and feel. And generally, those are the things that are useful to us too. And of course, the most important one, don't ever let emotions get in the way of launch. When we start talking about offshoring, a lot of it is emotion driven. So of course, the other big question that comes across to me a lot is, what do I think a wealth tax is going to mean for this country? As I said earlier, I don't lean too much into sentiment. I think wealth taxes are an inevitable fact of life in this country and everywhere around the world. As wealth gaps increase, we are facing wealth taxes. It's inevitable. I don't have any opinion on what it's going to be like if wealth taxes come in. I look at this as an entrepreneur. I say it's going to be really important to have a really good tax advisor, because when it comes to tax, there's always loopholes. There's always a way to dodge. Your estate structure is going to be really important. If you have a couple of million, you're going to have to figure out how to move that money around to make it tax efficient. Wealth tax is going to make it more important. I personally am way more concerned, and I believe everybody should be more concerned with the prescribing of assets than a wealth tax, which is basically government deciding how your pension funds will be used and loaned against. I think that is way more concerning than a wealth tax. And we have to face reality that the greatest threat to our wealth is not taxes, but inequality in a society. Because an inequality in a society means, and I'm not giving anyone a social speech here, but it means that you're going to have to pay private school fees, private medical, private, everything. Because that's what happens in unequal societies. Travel around the world and have a look where the cost of living increases drastically based on having to pay privately for these things. It is based on the fact that those societies are unequal. And the solution is not to vote for another political party, because it ain't going to change anything. I'm sorry to tell you guys. The solution is to make sure that you are diversified. To make sure that you build your ship so it can't sink. That is the key. This is going to be a tough one. I think the audience is going to throw something at me. A lot of people ask me this question, and so, especially sort of this demographic, we've got kids, we've got grandkids, got a little bit of money, should we buy our kids a home? Yes. Any of you have friends or thinking down that direction? Anybody got that thought lingering around, or know somebody has that thought lingering around? I have a very unpopular opinion about this, so please pass it on. I'll be happy for people to throw rotten tomatoes at me as I drive past. My answer is absolutely not. You shouldn't buy a property for your kids. This is my personal opinion based on my personal experience. It's not financial advice. But I'm going to tell you why. A lot of people who have money want to give their kids a better life. And in doing so, sometimes they enable the worst habits. And they're very well intentioned with what they're trying to do. But sometimes it's like handing a monkey a loaded gun, because they don't know how to use the gun. And so I am a bigger believer in handing down generational wealth. And generational wealth is not about handing money. It's about handing the knowledge that goes with the money. So if you are to give your children a house, this is how you should do it, in my opinion. I have 3 kids and I'll be doing exactly this. First of all, considering you're going to be in this country, if that is your objective, otherwise be doing another country, do the same thing but in another country. Create a property trust. Buy the property in the trust. Make your kids pay rent to the trust for that property until you drop dead. Your kids will get a couple of valuable lessons out of this, and grandkids if that's the route you choose to go. They'll get a couple of valuable lessons out of this. They will learn to look after an asset and treasure it and manage it. They'll learn the value of putting money into an investment that is self-managed and that compounds over time. And they'll get true generational wealth, which is not simply having money handed to them, but the baton. And that is generational wealth. Anybody here ever been scammed out of money? Okay. Don't feel bad, it happens. It's happened to the best of us. Steinhoff did a hell of a job on a number of people. Even the smartest people didn't see it coming. So let's talk about how to spot a scam. How do you weed out the nonsense from the fact? The most obvious one: unrealistic returns. So my general rule is 10% is expected and is capital preservation. 15% is really good and comes with some risk. 20% is gambling, and what I like to call speculative. Now, I have some great speculative investments that pay off from time to time, but let's be honest about it, I'm not an idiot, so I don't put all my money into those investments. You have a gamble once in a while, some of them pay off, some of them don't. That's life. But if you see unrealistic returns, then you need to understand that there's something probably wrong. 100% in 6 months doesn't exist. Unproven track record. The number of people who don't scrutinize the broker, the investment, the scheme. Ask questions, ask questions, ask questions. It'll get you closer to the truth than you can ever imagine. And last but not least, question everything, question everything. Thank you very much, ladies and gentlemen.